In today's digital age, the world of finance is rapidly evolving. Traditional banks are no longer the only option for securing a loan or investing your money. Enter peer-to-peer lending, a revolutionary way to connect borrowers and investors directly, bypassing the middleman. But what exactly is peer-to-peer lending, and why has it become such a popular choice? Is it a good idea for you, whether you're looking to borrow or invest? In this video, we'll explore the ins and outs of this modern financial solution, its benefits, and the risks involved. We'll break down how it works, the platforms that facilitate these transactions, and what you need to know to make an informed decision. From interest rates to default risks, we've got you covered. In today's video, we'll dive deep into the world of P2P lending, explore its pros and cons, and help you decide if it's the right choice for you. Let's get started. What is peer-to-peer lending? Peer-to-peer lending is a system where individuals can lend money directly to other individuals without the need for a traditional financial intermediary like a bank. This is typically done through online platforms that connect borrowers with lenders. Borrowers can request loans for various purposes, such as debt consolidation, home improvements, or business ventures, while lenders invest their money in these loans in exchange for potential returns. This method has gained popularity due to its flexibility and accessibility. Unlike traditional loans, which often require extensive documentation and credit checks, P2P lending can provide quicker access to funds, making it an attractive option for those who may not qualify for conventional loans. Additionally, the interest rates offered on P2P platforms can be competitive, benefiting both borrowers and lenders. For lenders, P2P lending offers an opportunity to diversify their investment portfolios and potentially earn higher returns compared to traditional savings accounts or bonds. However, it's important to note that this form of lending carries its own risks, such as the potential for borrower defaults. As a result, P2P platforms often provide risk assessment tools and allow lenders to spread their investments across multiple loans to mitigate these risks. P2P lending is a modern financial solution that provides an alternative to traditional banking, offering both opportunities and challenges for participants. It empowers individuals by democratizing access to capital and investment, fostering a more inclusive financial ecosystem. Pros of P2P lending. 1. Higher returns for lenders. One of the main attractions of P2P lending is the potential for higher returns compared to traditional savings accounts or other low-risk investments. Lenders can earn interest on their loans, which can be significantly higher than what banks offer. This can be particularly appealing for those looking to grow their wealth over time. 2. Access to funds for borrowers. For borrowers, P2P lending can be an alternative source of funds, especially if they have difficulty securing a loan from a bank. P2P platforms often have more flexible lending criteria, which can help those with less than perfect credit scores. This inclusivity opens doors for many who might otherwise be excluded from traditional financial services. 3. Diversification. P2P lending offers lenders an opportunity to diversify their investment portfolios. By spreading investments across multiple loans, lenders can mitigate the risk of default and potentially achieve a more stable return. This diversification can also include lending across different types of loans, such as personal, business, or real estate loans, providing further opportunities to manage risk. 4. Transparency. Many P2P platforms provide detailed information about each loan, allowing lenders to make informed decisions based on the borrower's creditworthiness, loan purpose, and more. This level of transparency can help lenders feel more secure in their investment choices as they have direct access to relevant data. Cons of P2P lending. 1. Risk of default. One of the most significant risks in P2P lending is the potential for borrowers to default on their loans. Unlike traditional savings accounts, P2P investments are not insured, meaning lenders could lose their principal if borrowers fail to repay. This risk can be particularly high for loans issued to individuals with lower credit ratings. 2. Lack of liquidity. P2P loans typically have a fixed term, and investors may not be able to access their funds before the loan matures. This lack of liquidity can be a disadvantage for those who may need to access their funds quickly. While some platforms offer secondary markets for selling loans, these markets may not provide immediate liquidity or favorable terms. 3. Platform risk. The stability and reliability of P2P platforms can vary significantly. As the industry is relatively new, not all platforms have a long track record of success. There is a risk that a platform could face financial difficulties or even shut down, potentially complicating the recovery of invested funds. 4. Regulatory uncertainty. The regulatory landscape for P2P lending can be uncertain as governments continue to develop and implement regulations for this emerging sector. Changes in regulation could impact the operations of P2P platforms and, consequently, your investments. Is P2P lending right for you? Whether P2P lending is a good idea depends on your financial goals, risk tolerance, and investment strategy. If you're looking for higher returns and are willing to accept a higher level of risk, P2P lending might be worth considering. However, it's crucial to do thorough research, diversify your investments, and only invest what you can afford to lose. Remember, like any investment, P2P lending comes with its own set of risks and rewards. It's essential to weigh these carefully before deciding to invest. Additionally, consider the platform's reputation and borrower vetting process. While some platforms offer robust borrower assessments, others may not provide the same level of scrutiny, increasing the risk of default. Furthermore, liquidity can be an issue. Unlike traditional stocks or bonds, selling your P2P investments before they mature can be challenging. The level of protection for your investment also varies, as P2P lending generally lacks the safeguards found in traditional banking, such as deposit insurance. Another important factor to consider is the economic environment. During economic downturns, the risk of borrower defaults may increase, potentially impacting your returns. Staying informed about market conditions and trends in the P2P lending space can help you make more informed decisions. Lastly, keep in mind that while P2P lending can offer an opportunity to support individuals and small businesses, it requires a proactive approach to manage and monitor your investments. Whether you're new to investing or a seasoned investor, understanding these dynamics is key to navigating the world of P2P lending successfully. That's it for today's video on peer-to-peer lending. If you found this information helpful, please give us a thumbs up and subscribe to our channel for more financial insights. Let us know in the comments if you have any questions or if you've had any experiences with P2P lending. Thanks for watching, and we'll see you in the next video.